It's very easy to lose money in any financial market, but if you learn the core concepts of supply and demand and how it determines the market prices, you will be able to profit consistently by following the institutional traders who control the market. In this video, we will be going into the details by profitably detecting and trading supply and demand zones for day trading. We will also be revealing to you the advanced strategy that took us years to learn, and now you'll be able to learn it in 15 minutes. And towards the end, we will also show you how by using different confluences you can increase the winning probability of your other strategies as well. But before we get started with the video, please click the subscribe button and press the bell icon to get notified, because we have a lot of great content planned in upcoming videos that you never want to miss. So without any further ado, let's get started. The first thing that we will cover in this video is understanding why you need to learn supply and demand. Forex is a $6.6 trillion market, and retail traders with a percentage of 5.5% do not have enough volume to move the market in desired direction. Rest of 94.5% of the market is institutions, which includes hedge funds, investment managers, multinational corporations, and central banks. So as a retail trader, it's only wise to trade with institutions because you have a great edge over other retail traders. Now let's dive into learning the supply and demand. The driving force behind the changes in price in any market is supply and demand. Market has generally one of these two phases at all times. The first one is the balanced state, in which the market is moving inside a range and there are no impulsive moves or gaps in the market. This represents that the forces of buyers and sellers are equal, and market makes this ranging structure. The second phase is the unbalanced state, in which the number of buyers and sellers are not equal, and it is in this state where the supply and demand zones are formed. And in the unbalanced state, the market or the price will move very impulsively in either bullish or bearish direction. So when there are more buyers than sellers, the market prices will move up, and this means that there is demand in the market. Conversely, when there are more sellers than buyers, then the market prices will move down, and that means there is a lot of supply in the market. These simple concepts are very powerful and allow us to analyze the naked charts and determine where the price is likely to go. Let's understand this through an example. Let's say that a company releases a new tablet computer. If these tablets can't move at the price at which they are being sold, then the prices will drop because very less people are willing to pay that much and buy the tablets at current price. And the company will have to decrease the price to sell these tablets. The price will continue to drop until the price finds the balance with which the buyers are willing to pay. So you see how the increased supply of tablets with less number of buyers decreases the price. So this is the effect of the supply on the market. Conversely, if there are more buyers than the tablets that are being produced by the company, the prices will rise because there is a lot of demand in the market. So we can say that these two things are very prominent in supply and demand. Number one, the buyers dictate the demand in the market and the sellers dictate the supply in the market. So now that you know about how supply and demand moves the markets, we would want to detect the supply and demand zones so that we can trade with institutions and generate profits while day trading. And as a side note, supply and demand zones are forming almost at all time frames. But to be a profitable day trader, I would recommend you to trade supply and demand zones at time frames above 30 minutes. There are two types of supply and demand zones. First, we're going to go into the details of demand zones. In the demand zone, there are three market phases. The market structure of a demand zone looks like this. Here, the first phase is an impulsive move in the bullish direction, which represents the huge momentum of buyers. This phase is called rally. So in the first phase, the buyer controls the market. The second phase consists of arranging market structure in which the number of buyers and number of sellers are almost equal, which means currently the market is in indecision phase and this phase is called base. Then in the third phase, the market again moves impulsively in the bullish direction, showing the dominance of buyers, and this phase is called the rally. So this is the market structure of a rally base rally demand zone, and the zone will be drawn at the boundaries of the second phase or the base region. As you can see, the high of this base is the high of the demand zone, and the low of this base will act as a low of our demand zone. The second type of demand zone is drop base rally demand zone. And in the market structure of a drop base rally demand zone, the first phase is an impulsive move in the bearish direction. This is called the drop. The second phase is a ranging market structure called the base. And the third phase is again an impulsive bullish move. The drop base rally demand zone will also be drawn at the highs and lows of the base zone. So there are two types of demand zones, the rally based rally and the drop based rally. By the way, we also have a supply and demand indicator which can help you detect the supply and demand zones automatically on the charts in real time. And it comes with the powerful features like custom candle body sizes and real-time alerts. So as a day trader, it can help you save time and effort. I have put the link to the indicator in the description, so if you're interested, please make sure to check that out. Now let's move towards the supply zones. Similar to demand zones, there are two types of supply zones, the drop-based drop and rally-based drop. In the drop-based drop, the first phase is an impulsive bearish move, which shows that the sellers are driving the market in bearish direction. The second phase is a ranging structure called the base, and the number of buyers and number of sellers in this phase are almost equal. And the third phase is again a bearish impulsive move in showing the dominance of sellers. In rally based drop, the first phase is an impulsive move, then the second phase the market is ranging, and in the third phase there is again an impulsive bearish move. So the two types of supply zones are drop based drop and rally based rally. To trade the supply and demand zones, we first detect the zones, and if it's a demand zone, we will put the pending buy order at that zone, and if it's a supply zone, we will put the pending sell order on that zone. After the formation of the zone, the market will come back to that zone to pick these pending orders placed by the institutions, and within that, our pending orders will also get fulfilled. Let's see this through an example. To detect the supply and demand zones, there are two ways. One way is to detect the supply and demand zones manually, and the second one is that you can use the supply and demand zone indicator to detect the zones automatically on your charts. But before we start drawing the zones on the chart, we should know that the impulsive moves, which represent the rally and drop phases, are represented by the candles on higher time frame with a high body to wick ratio. For example, here is a candle in which the total candle is from this high to low, okay, and this is called the range of the candle. The actual body of the candle is between open and close. So if we want to calculate the body percentage of this candle, we can divide the number of pips of the body by the number of pips in the total range of the candle and multiply it by 100 to get the percentage of the body in the candle. So after calculating the body percentage of the candle, we should keep that in mind, that the body percentage of drop and rally candles should be greater than 60, so that it should represent the clear or huge momentum, and the body percentage of base region candles should be less than 30%, representing the ranging market. So here on the charts, we can see the formation of this rally base rally demand zone, and as we discussed earlier, we can draw the zone at highs and lows of these base candles. This is how we can manually detect the zones. The second way is we can just use the supply and demand indicator. So when I go to the charts and apply the indicator to the charts, here we can see that it starts to show the supply and demand zones. So in order to trade this demand zone, we will put the buy limit order at the high of this zone and put the stop loss at the low of this zone. So after the formation of the demand zone, the market will move up and then it will come back in order to pick those pending orders. After picking the pending buy orders, the market will move up. Now let's go through an example of a supply zone. Here you can see the formation of a drop, base, drop supply zone, and the supply zone is around the base candles. In order to trade this supply zone, we will put the sell limit order at the low of the supply zone. And the market after the formation of the zone will move down and then come back in order to pick the pending orders and then again move in the bearish direction. This is how you can trade supply and demand zones. Now let's talk about how you can increase the winning probability for trading supply and demand zones. And as a day trader, this is important. So what you can do is you can set your charts to daily time frame and see if you can spot any supply or demand zone there. In order to do this automatically, you can use the supply and demand indicator as well. For example, here we can see the formation of a supply zone at daily time frame, and after picking the pending orders from the supply zone, the market is headed in the bearish direction. So when we go towards a lower time frame and see any supply zone forming, we should be comfortable to trade that because the price is already moving in the bearish direction at daily time frame. Another way to trade supply and demand zones as a day trader is that when you detect a zone on the charts, then you should look for key levels in the past. And if you spot any key level at the same level where the zone is, your chances of making profits from that trade will increase. So I hope you guys like this video. Please make sure to comment if you have any questions, and also subscribe and like this video to show your love and support. See you guys in the next video. Thank you.